Hi, in this video, we will learn the treatment when creditors take over assets in settlement of their dues. Let's go to the examples. First example, let's say creditors in the liability side of the balance sheet is rupees 25,000 and stock in the asset side of the balance sheet is rupees 20,000. Let's say we are given the information that creditors agree to take over stock in full settlement of their claims. So the full amount of creditors is being discharged by taking over stock. And in this case, there will be no journal entry in the books of accounts of the firm. Example 2. Let's say creditors in the balance sheet, the liability side is 25,000 rupees and stock in the asset side of the balance sheet is rupees 20,000. Let's say we are given the information that creditors agreed to take over stock at rupees 18,000. Now the entire stock is taken over, but the value at which it's taken over is 18,000 rupees, whereas the creditors' book value is 25,000 rupees. So even in the absence of information, since where the question is silent as to the treatment of any external liability, we need to pay it off at book value. The difference, which is the 25,000 rupees book value minus the value at which the stock is taken over, rupees 18,000, the balance rupees 7,000 has to be paid off. The journal entry for payment of creditors rupees 7,000 is realization account debit to cash or bank account. Example 3. Let's say creditors in the liability side of the balance sheet is rupees 25,000 and stock in the asset side of the balance sheet is rupees 20,000. Let's say the information given is creditors agreed to take over stock worth rupees 15,000 in full settlement of their claims. And there's further information given that balance stock realized rupees 3,000. Now, as far as the creditors is concerned, they have taken over stock of rupees 15,000 in full settlement of their claims. There will be no journal entry for this transaction. However, the balance of 5,000 book value of stock realizes rupees 3,000. We need to pass an entry for this, and the journal entry for this would be cash or bank account debit to realization account rupees 3,000. Fourth example, let's say creditors in the liability side of the balance sheet is rupees 15,000 and stock in the asset side of the balance sheet is rupees 20,000. Let's say information given is the creditors agree to take over stock worth 15,000 at rupees 12,000. Now, even if nothing else is mentioned in the question, as far as the creditors are concerned, the book value is rupees 15,000 and the value at which they take over the stock is only rupees 12,000. So the difference has to be paid to them in cash. And so we will pass the journal entry realization account debit to cash or bank account for rupees 3,000. Now, on the other hand, the stock book value which is given in the balance sheet is 20,000, and only book value of rupees 15,000 is taken over by the creditors. We still have stock book value rupees 5,000 left, but since there is no mention in the problem about the asset, we will have to assume that nothing is realized from the sale of the balance stock book value rupees 5,000, and we should not pass any entry for the same. Only for the creditors payment, the difference between the book value of creditors and the value at which the creditors are taking over the stock, which is rupees 12,000, the balance difference, whether it's mentioned or not, we need to pay it off at book value. So realization to bank account rupees 3,000. So in this video, we learned the various combinations of creditors taking over asset in settlement of their dues and understood the entries to be passed in each of these different circumstances.